Hello everybody. I am sorry that the broadcast was not working. I had some problems with the live streaming. It was not available and God knows what. So I hope that you were all here, that you still are, that you didn't give up on me and that we can compensate you a little bit for the wait. All right, so please, before we start, let me know if you can hear me, well. Vincent says it works now. Thank you so much. Everybody's hearing me well? Let me know so we can begin. Wonderful. Great. So let's begin. So let's see how we're going to begin with today. The very first thing I'm going to talk about is to clarify the concept. I hope that the video, the dual moving average video was clear enough. However, I want to clarify it for you. Typically, when people refer to a golden cross or a dead cross, typically they are referring to the crossing of the 50 moving average with the 200 moving average. That is wonderful. It's great. It's acceptable. And some people will simply do those crossing and they will be happy with them. Likely. Now, do those crossings correspond to the gold and dead cross that I speak about? The answer is no. When I speak about golden cross and dead cross, I'm speaking about the crossing of a shorter moving average above a slower moving average that is already pointing in the direction that the shorter period moving average is crossing. In other words, if you are going to buy, you want a shorter period moving average to cross from below above the longer period moving average, the slower moving average. But that slower moving average should already be pointing in the direction that you are going to trade. If you are going to sell, you want the longer period moving average to be pointing down and then the shorter period moving average to cross it from above. And those are what I call golden crosses and dead crosses. And that is pretty much regardless the period of the moving average that you use. And the reason why I'm clarifying this is because several comments have said, the 50 and the 200, the 50 and the 200. Yes, those are typically considered the golden and dead crosses. The tweak that I have incorporated is precisely the one that makes the huge difference. I'm going to give you an example here. I'm going to show this chart actually pretty much randomly, and I'm going to put those long period moving average. I'm going to use the 50 and the 200. Okay, here we have it. And I want to show you why I am not really a friend of these crosses. At least I don't consider them golden and dead crosses. For example, right here in front of us we have one. This one is the 50, the thicker one is the 200. Well, according to this definition, when the thin one crosses the red one, the thicker one, we have a sell signal. Now, that happened pretty much at the low. And look at what happened right after. Prices started going up. So when I talk about the golden and the dead cross, I'm looking for situations that are pretty ideal, and they don't really correspond to these long-term period moving averages. For instance, if I were to use the dead cross and the golden cross, instead of using the 50 and the 200, I probably would use the 50 and the 100, because I know that those periods, even though they are not the traditionally ones used to define those two type of crosses, I know that with the tweak that I have incorporated, meaning that the longer term moving average must be pointing in the direction that you're trading, then I'm pretty sure that would give us seriously good odds in our favor. Now, please don't misunderstand me. I am not saying that doing the golden and the dead cross using the system that I'm showing you, you're never going to lose. That is not true. I mean, do these things fail? Of course they fail. And do they fail often? Well, not that often, but they do fail. And I actually can show you in this same chart, because I was looking at this chart before we started. I can show you with different period moving averages how they fail. Okay, and with that I'm going to show you how to avoid the taking the bad signals. For instance, in this particular case, we have the what is it? The 4-hour chart, and I'm using the 18 and the 40. Why am I using the 18 and the 40? No reason. It's simply that, you know, when you are trading, let's say, longer terms charts, you probably want to use periods that are like the 18 and the 40, maybe the 20 and the 50, something like that. You're looking for day swings, and then you probably would be benefiting from those type of combinations. 2050, 1840. On the other hand, if you are looking for intraday charts, you are more of a scalper. You want to trade of a 10-minute chart or a 5-minute chart. Then you probably want to use the 10 and the 20, maybe the 13 and the 21 period. And sure, many people talk, I use the exponential. Sure, the exponential would work well, particularly for the faster period. In other words, let's say that you use the 10-20 combination, then you can use the 10 exponential moving average with the 20 simple moving average. And the only reason, there's no secret there, the only reason is because the exponential moving average is more sensitive. It reacts faster. So it makes sense that you want to use the shorter period exponential, because you will have more sensitive moves and quicker entries. Now, if you are looking for multi-day swings or something of the like, then you probably don't want to use a 10 and a 20. You probably want to go with a larger period. So in that case, if you're doing your trading of a daily chart or a weekly chart, you probably want to look at the 50 and 100, as I said before. You could also use the 50 and 200, of course. But 50 and 200 require that you really take much longer views of the market. So now I was going to give you an example of how the golden crosses sometimes fail, right? Because I don't want you to get the impression that I say, with my twist you'll never lose. No, you will lose. But I can also guarantee you that if you use my system, more often than not, you are going to win. And at the end of the day, you are going to end up making good profits. And the reason is because you will be putting the odds in your favor. Now, here is an example of a golden cross that didn't work. Why is it a golden cross? Well, look at the red moving average. That would be the shorter term period. That's 18. Look at it, it's crossing from below. I can make it bigger so you can see better. It's crossing from below the 40 period, okay, which is already pointing up. Okay, so that should be a very good entry. But look what happened. Precisely right after that, it hit top and it started coming back down. So the golden and the dead crosses with the trick that I am insisting you use will also fail, but it will fail in very, very few opportunities. We can go through the chart and you can see for yourself. Let's make it on a daily, so it's a lot easier to look for several examples. And then with your help, you're going to tell me if you identify if a cross is worthy or not. For instance, here the red, I'm going to talk with the red instead of saying the shorter term period, because that's really like a tongue twister, right? The red one crossed from above the blue one. So that should be a sell signal according to the normal systems of dual crosses in moving averages. Typically, when the short-term moving average crosses the longer term from above, it means a sell signal. It means that the prices are falling faster than they are going up, so you should be selling the market. So here we can see that it didn't work. But on the other hand, I want you to tell me, was that a dead cross? And if it wasn't, tell me why wasn't. I see there are many comments, so I'm going to go through them now. How about 20 and 50 for swing? It really doesn't matter, Vivek. There is no magic system here. You can use the 20 and the 50. You can use the 21 and the 49. It doesn't really matter. Those things are not that sensitive. In fact, you can adjust the things according to the time frame. And to adjust them is very simple. I can show you little tricks so you can see how to adjust them. It doesn't require that you become a technician or anything like that. But for instance, let's say that I chose here to use the 18 and the 40, okay? Then I check, was this, let's say, historically accurate? Look at 18. The 18 found, the prices found support at 18, found support here, found support here. Did it work? The 18 obviously worked. So can I use that one? Absolutely. Because I know that it found support, let's say historically. You look at how well it worked here. It's not because it just, I chose this one because it was magical. Not at all. It was because, well, this works pretty much standard in this market, no? But you can choose, well, I don't like the 18, I like the 20. That's fine. And instead you don't like the 40, you like the 50. That's fine. No difference. You shouldn't complicate the systems that much because they are not going to make that much of a difference in your results, and you will see. The things that do make a difference is the little tweaks that I'm telling you about. Okay, I hope that answers your question. Let's see. Okay, the reason why we couldn't enter that is because the slow, this is not an EMA, this is an SMA, but it doesn't really matter. Again, you can use two EMAs if you want. I wouldn't see the reason why, but sure, you can use two EMAs instead of two SMAs. As I said in one of the comments, it doesn't really matter what my preference is, but I am a simple guy. I don't really get too complicated. So I use simple moving averages. Why? Because in 30 years of trading, I've not seen much of a difference. There is no much of that. Well, I use the 11th EME instead of the 12th SMA. It doesn't make a difference. Anyway, so the answer was correct. You said we could not enter here because the blue one was rising. And this is precisely what I said in the video. This is an X. Okay? This shows you don't trade there. Okay, this is not a place where you want to listen to that signal. Okay, so now let's continue. Let's see here. Is this a good signal? Don't look at the price, because of course if you look at the price you're going to say, of course, look at how it raised. Now, it doesn't really matter. Prices went up, sure, but was the signal right? No, it wasn't. It was a dual crossing signal, like all the dual crossing signals that you have probably learned and applied, and you know that they fail very often. Of course, that's why you get frustrated. Because that type of blind entry, let's say, well, that's not really succeed a lot of the times. And so you have to get lucky. You got there here, you went up, you went long, you got lucky, and sure it went up. But was the signal correct? No, because the blue one was pointing down. So for this signal to be correct, well, this had to be here. Now, would you want to enter here? Probably not. Could you? Yes. And I could show you how you could do this in a moment. But first, I want to clarify the concept so you have very clear understanding of this. So, let's see. Now, we had one entry, didn't work. This one didn't work. But look at this one. The blue one is pointing up. The red one crosses it from below, and look how wonderful of an entry that was. Now, it is very hard, and I would give you the challenge. Look at many charts, different time frames, different period moving average combinations, and look for golden crosses or dead crosses that didn't work. And you will see that you will find many dead crosses and many golden crosses, but you will find out that the majority of them worked. And that is the reason, and that's why I was so bold in the video as to tell you, do this and you shall make money, because that is absolutely the truth. Now, having said that, I have to say, no indicator, no moving average system will ever substitute your observations and analysis. No indicator will ever take the place of proper forecast and price analysis. The context, just as I explained in the last live stream, the context is key. So, for instance, the majority of you probably took my live stream for Elliott waves, and so you probably all know how to count waves. So let's say here you have 5 waves there, 1, 2, 3, 4, and 5. So if we are expecting a wave 5 here, would we take this signal, even if it is a dead cross? Well, absolutely no. Why not? Well, because we have only 3 legs there. We need 5, right? So you need context. If you know how to count to 5, as you know, as I said jokingly during the live stream, so you know 1, 2, 3, 4. You're expecting a 5. Well, you know, when you're expecting a 5, you know prices should be going up. In fact, you can see those 2 lines there where my target, because I don't think this is done yet. But that's the point. Now we're expecting prices to go up. Will this signal mean something for us? Well, it means gold for us. Hence, the golden cross. Because we are waiting for a 5th leg up, and this signal here will tell us screaming buy. Now, in the meantime, in the middle of this, many of you have complained, oh, well, this doesn't work on sideways markets. Well, no system works in sideways markets, particularly if you are using a trend following system. Moving averages are trend following indicators. Now, to this day, I don't think nobody has ever created a system that works in sideways markets. And of course, you can use oscillators, but even the oscillators which work much better in sideways markets will fail tremendously. So if we had found a system that works in sideways markets, well, the majority of traders would be trillionaires now. But here's the thing. Using the moving average correctly, within context, then will keep you away from sideways markets. For instance, you know, as I said, the context tells you, your analysis is telling you prices are moving up. We have a 1, 2, 3, 4, and now we need a fifth one up. That one is projected to come here or here. These are the two projections we have. Okay, notice that it got here and jumped from there, but probably not the top yet. Now, in here, do we care that this part was sideways? No. Do we care that all this sideways was sideways forever? This has been sideways for, this is a daily chart. Imagine how many days it went sideways. But no, it doesn't matter. It doesn't mean anything for us because, first of all, the signal was here, okay, and we're taking a signal within the context of the trend. That's why we always said that you need to learn. That's the key. You need to identify the trend. Identifying the trend is the most important thing that you can possibly do. So some people have asked, well, can I use a longer term moving average there to identify the trend? And yes, indeed. The answer is yes, indeed, because let's say that you have a 100 moving average here that is moving like that, and you're using the 100 to identify the trend. Well, of course, while the trend is up, in other words, while prices are above a moving average, a larger moving average that is pointing up, of course you're going to consider the trend as up, and then you're going to consider in the buy signals that the crossing gives you. That is context. However, even if you don't have context, all these little tweaks that I have told you, for instance, using the moving average, the single moving average with a 30 system, the idea of exiting the trade with the second close, if the second close closes below the two previous relative lows, is precisely to avoid the sideways markets. That is precisely the essence of that technique. It's not that the 30 is magical. Some people have written in the comments, I don't see a difference between the 20 and the 30 period. Well, no, there is not much difference. You can use the 28 and 29. There is no difference with that. So can you use the 20 instead? Sure, you can use the 20 to identify the trend, but the tweak, the whole essence of the strategy is precisely how do I avoid getting out of the trend of the trade when it wasn't necessary. Because if I get out of the trade because the prices close below the moving average, well, maybe it will continue going up again. It will resume the trend and I just exited the trend for no reason. That's why we gave you that specific tweak, which was look at the two previous relative lows. And don't take just one close, take at least the second close. Okay, I hope that clarifies that. Let me read the comments because otherwise I'm going to miss too many comments. All right, so I want to answer many questions. I wanted to give you the specifics of how the whole thing works and then address the objections and address your questions. What is the difference between EMA and SMA? The only difference is that EMA is calculated differently. It gives more weight to the most recent prices, whereas the SMA gives equal weight to all the periods that you are using. Let's say that you are using a 10-day period. Okay, so you are going to be using the close of the day 10, day 9, day 8, day 7, 6, 5, 4, 3, 2, 1. And then you're going to add up all those values, and then you will be dividing them by 10. So they're all going to be exactly the same. It gives the same way to all those periods. So some people say, well, if I'm using the 200 moving average, what do I care about what happened 200 days ago? I'm more interested about what happens in the previous 3 days or something. And that's why they created these different ways of calculating the moving averages, which not always are more beneficial necessarily. They can give you different information, but not necessarily more beneficial. It's not that the EMA is so much better than the SMA that we shouldn't use SMAs ever, because that's not the case. In fact, the SMAs may be a lot better than the EMAs in many opportunities, because, as I said, the EMAs are giving more weight to the most recent prices, and sometimes that's not precisely the best scenario that you want to be at. And also, if you are scalping, if you are day trading, obviously you want something that works faster. And because when you scalp, you want to trade with momentum. So in that sense, of course, it will be better to use EMAs or weighted moving averages. And that's the reason why so many traders are going nuts about the EMA. The reason is because they are scalping and then they think they found something invaluable there, because it gives quicker answers, let's say, but not necessarily always better. So that's mainly the difference between the EMA and the SMA. And the next question is, can we club it with MACD to refine it more? Absolutely. In fact, you can use this strategy with, you can use it. To be honest, when you see, let me put it this way, I'm going to be personal now. When I see golden and dead crosses, I'm interested, but very interested. When I see a single, a normal dual crossing, that could be one of those. Because when the markets are sideways, that's precisely what happened. It starts crossing up, it starts crossing down and crossing up and crossing down. That doesn't work. That brings a lot of frustration. But when the larger moving average is already pointing in the direction that you're looking at, let's say that it's pointing down, and you're looking at the dead cross, well, by the time, if the market is trading sideways, by the time the moving average, the larger term moving average, start pointing down, it's because there are more forces pointing, there are more selling, forcing the moving average to turn down. And so it is very, not rare, but it's very difficult that you have a larger term moving average pointing in the direction you want to trade. And by the time that the shorter term crosses it, it's very difficult that the market is not trending already in that direction. And that's why those tweaks are so important. And that's also why the making sure that the longer term is already pointing in that direction will avoid in a large percentage the sideways. Not in 100%, but in a large percent. And that will make a difference for you. A huge difference, I may say. All right, so why MA 18 and 40? Because those were the ones I had there. It's no different. No reason why. Why not the 20 and 50? Yeah, we could change them to 20 and 50 and do exactly the same that we're doing right now. A quicker answer about, I wouldn't understand it, wouldn't be DMA. Not so sure what that means. Sorry about that. Why are the moving average here offset? Because I like offsetting them. That's the only reason. You don't have to. I like them like that because, yeah, it gives me a better perspective, and it kind of make it more predicting. For instance, right here, you can see that because they are offset, you can see that the 18 is already flattening, maybe preparing for a crossing. And actually I'm looking for a crossing down, because look, I'm expecting a 3, a 4, and a 5th, and look where the 5th is. It's very close by. So I'm looking for a little move higher, and then a turn in the market that should be dramatic enough as for me to participate in it. And so having those two moving averages there would see me that they are already preparing with the offset. They are already preparing for the crossing, so that would be really great. Now, I showed you before, and I'm going to give you one of the best tricks that you can possibly have using the moving averages. For instance, right here, and believe me, this aspect that I'm going to show you now is as important as the tweak for the golden and dead crosses. Okay, as important, because it is possible to trade normal crosses. For instance, in this case, we said that this cross was not valid. But not valid how? Not valid in terms of a golden cross. It isn't a golden cross. Why isn't a golden cross? Well, because the longer term moving average is still pointing down. It's flat, right? Little pointing down here. If we see it like this, we would see that, well, it's turning down. It's not turning up. So it's not a golden cross. But can we trade it? Well, sometimes we can. And when that happens, we can take really good trades. So please pay attention, because what I'm going to tell you is extremely important. And it will also make you money. It's different from what I told you in the video, but it's going to help you a lot. Again, this is not, to be honest, nothing in trading is 100%. Absolutely nothing. Not even my beloved Elliott waves. Nothing is 100%. The point that we have with technical analysis is that we put the odds in our favor. Okay, so if we have different tools, different strategies that somebody was suggesting to use MACD together with this, of course, any time that you pile evidence in your favor, you're going to have the odds in your favor. And then likely that is not going to reflect only on you making money, but it's also going to reflect in your psychology, because you will have more confidence, because you knew that you took a trade where everything was pointing in that direction. You did the right thing, so to speak. Okay, so we saw this crossing, and then we said, well, this could be one of those crossing down, crossing up, and maybe crossing down again. So what do? Can we trade it? Yes, we can. But how? Well, whenever we see a crossing, what we do is that we wait for prices to retrace and possibly find support in either one of the moving averages, or ideally in the middle, like in this case. Okay, so that happened. Shall we buy there? No. Why not? Well, because the prices could be coming down, and then we will lose again, right? So where should we buy? Well, when we see this, and here is the wisdom of this, when we see this, we wait. We wait for prices to move higher. And then when they break this, now we have some confirmation that this crossing here was real, was worthy. And so you buy here, and now you are in a much better position. Make sense? Notice, I'm going to show you right here, right in front of us. We can see Okay, yeah, now you can see that I don't know how to use this stuff. Okay, now you can see here. For instance, it crossed down. So now we're waiting for prices to move up, find resistance in one of the moving averages. It did here. And so we didn't want to sell there, right? Remember? Why? Well, because we didn't know if it was going to continue. So we were waiting for this low to be penetrated, but that didn't happen. And that's why this is going to help you. This little trick, using dual crosses, will make a significant difference. I'm not so sure it's as much of a difference as with the golden and dead crosses, but it will make a significant difference. And if you combine those things, you're going to be really in good shape. I'm going to see a little bit more of the comments, all right, because I think I see more comments coming and I cannot read them. You're saying the truth. I use moving average for market direction or trend, but I don't bother whether the SMA or EMA. Yes, of course. I just use SMA always. Doesn't make much different on the chart. You are correct. It doesn't. It's only, when you gain a lot of experience, you realize that, yes, they are good. It's good to use weighted moving averages. It's good to use exponential moving averages. But, they won't make the difference. You know what's going to make the difference? Those tweaks I'm just giving you. That could make a huge, huge, significant difference. And what I suggest is, don't listen to me. Just go and test it. Test it, back test it again, and then tell me if it worked, if it made a difference. If it didn't, okay, then don't use it. But you will probably see that it will make a huge difference. Can we use it in a weekly chart? Absolutely. Absolutely. All these strategies, you can use them in all time frames. Now, consider the possibility that if you are going to use them in shorter time frames, which is the preferred choice for the majority of traders who are beginners, and it's absolutely the wrong choice, but this is what people want to do when they are novices. If you are going to do that, you have to adjust the periods. You're not going to use the same period that you use in a weekly chart for a 1 minute chart. Okay, is the period magical? No, you have to test it. Test it to see if it worked, how it worked historically. That's all. Okay, does this method works as continuation of existing trends? Absolutely. In fact, you can see the trend here. Oh. Okay, I have to laugh at myself because, there is no way that I can learn how to use this tool. All right, so here, for instance, the trends start here, right? And let's say that we wanted to buy here, okay, which actually would have worked. But we didn't, for whatever reason, we didn't see it. It doesn't matter. We started seeing it later. And the trend was already established. Look, the trend is already going up and going up. And look at this. It's a continuation. And it worked as a continuation. Now, when it is a trend reversal, typically it won't work the first one. So in other words, you won't get the first signal as a golden signal or as a dead cross. You will get the second one. Okay, for instance, the first one, let's say the first crossing will be something like this, and this will be still going like that, right? But the next crossing will be when these are already going like this, and this one will have already been established as down, and then the next crossing will make it as a dead cross. So right there, that's the one that you can use, not blindly, but that you can use with extra confidence because it works a high percentage of times. So it works as continuation of an existing trend, and it also works as a trend reversal, but not right in the beginning. Sometimes it does. It depends on how long the market took to form the bottom or form the top, because sometimes, those places are very difficult to form and the market takes weeks or months to form them. And then when that happens, it is possible that you get a golden or a dead cross. If you are scalping 5 minutes or 15 minutes, do you go as far as a day to make analysis? Or is it too far? Maybe only 4 hours and down. If you're trading on a 5-minute chart, you have no business looking at a daily chart. Why? Look at the bar on the daily chart, okay? When you look at one bar, can you make an analysis? Well, not really, because you don't have anything to compare to. You compare when you have a bunch of bars that you can see, well, higher highs, higher lows, this one is higher still. Okay, but if you are going to, analyze this bar, what does it mean? It means nothing. Now, consider how many 5 minutes are in a day. So it doesn't help you at all to be looking at a daily chart for your 5 minutes entries. Doesn't make any sense at all. Where would you put a stop on this daily yen example? If we're talking about this one, if you're talking about this particular golden thing, well, I didn't address a stop here because the point for me here was to show you the tweak of a system that would make a difference. Now, for stops, there are, I don't know if I should say an infinite, but there is an innumerable ways of using stops, okay? And it depends really on so many factors. For instance, I prefer to use the system I taught on the single moving average magic video. Why? Well, because that system allows me to avoid that I exit too early, okay? So that is one reason. Now, typically, I won't take stops that are not based on price structure. And that's why using the two previous relative lows, help you with structure even if you are not making a proper analysis. But for instance, if I'm going to trade this, okay, I know that as I said, I'm expecting a wave 5. Where would I go wrong? Well, there I have to go back to what the rules of the trend tell me according to Elliott wave. If this is indeed wave 1, which is the reason why I want to go higher there, well, then I'm going to use a stop this one. So I'm always going to use structural stops. But there are so many ways to use stops that I can't tell you. I mean, I could give you an innumerable ways of doing so, but you have to test whatever works best for you, because when the stop is used, is too large, for instance, for you to be able to handle, then your psychology will be destroyed, and anything that happens in the market will make you take the wrong decision. For instance, a wonderful way to use stops is, look at this. Don't look at the indicator, okay? Just look at the dots, okay? This is a wonderful way of using, this is the SAR, okay? The stop and reverse indicator. I think this is a wonderful way to use the stop, because if you trade it, I forgot where the crossing was, but let's say the crossing, you enter here. Well, the stop will be where the SAR is. And this is a very good way of using stops. It's a system, okay, and it helps. So there is not a one size fit all for stops, because some people use money stops. They say you are trading money, so you should risk only the money that you want to lose. Well, that concept has never worked for me because I have never wanted to lose any money. Therefore, I don't use money stops. I hope that answers you, even though the answer is a little bit ambiguous. But if you don't know how to use stops that are structural, then use the two relative lows, or use the stop and reverse. Some people use ATRs, to measure the stops. It makes some sense, but not a lot. So that could work as well. We could have taken February golden cross and stay in trade because the two close the 16th of March is not below. You understood that correctly, indeed. So we can go back if you want and use those. And so where is March? Let's see, where is March? Okay. Yeah, this is the one that you're referring to, right? And yes, I don't have the 30 here, but it doesn't matter. Let's not use the 30. Let's say that we're using the 40 this time, because whatever. Okay, so we had the two closes here. Well, they are not lower than the previous relative lows. In fact, this low here is still higher than one of the relative lows. So yes, indeed, you would have stayed in the trade still using that technique. Yes, it would have worked. All right. This crosses strategy works better with clear trends, right? But not ranging. That's correct. But again, this is like one of those objections that people write in the comments. Moving averages don't work because they are lagging indicators. Well, what indicator is not a lagging indicator? All indicators are lagging indicators, all of them. And some say, well, it doesn't work in sideways markets. You should say that. Well, everybody knows that moving averages don't work in sideways markets, and no indicator works in sideways markets. So, but what we are showing you, the tweaks that we have been giving you on how to handle, how to manage those trades, actually help you, not 100%, but it helps you tremendously to stay in trades even though you are on the sideways market. Okay, so many times, as I showed you before, for instance, look at this. This is the daily chart. Look how many days we were in the sideways market. Did it matter for us? No. It was days and days and days, but it didn't matter. You see what I mean? Okay, this tool will stay in drawing mode. Try clicking on the cross icon to stop drawing. Thank you so much, Al. I wish I could have that memory. But when I start teaching, I get all excited. I forget what do I have to click and whatnot. But you're right. I am completely unable to use these tools. Okay, I had to reprogram my mind to move away from scalping. It is close to gambling. I'm so glad that you saw that, because scalping works. It can work, but you have to be an absolute maestro of trading. You have to be an absolute maestro of your own self, of your own emotions, because scalping, it has so many things against you. It has news, algorithms. It has all kind of things that influence whatever you decided to do. So the indicators will be practically meaningless when you are scalping. So I'm glad that you that you realize that. Now you're using a 4-hour time frame. Wonderful. Is it safe to use 200 to know the trend? It depends. It depends what you're looking at. If you are using the 200 moving average in a daily, 200 daily moving average in a 1 minute chart, is it safe? I mean, it won't help you. not at all. You know how many minutes the prices could be below the 200 daily moving average before it reaches it? It could be months. So it depends. Now, having said that, let me tell you, typically people define the trend as below or above the 200 moving average. Okay, is that a perfect way of seeing things? Not perfect, but it helps, because if you are above the 200 moving average, for instance, and then you are using the 30-day strategy that I showed you, or you are using the golden or the dead crosses, or you are using the trick that I just gave you where the breakout after prices have retraced and found support or resistance in between the two moving averages that you're using. Well, if you are using that, but you have a 200 moving average that is below all that, well, you are going to have a lot more confirmation. So that's much better indeed. Okay, and also, I'm curious. I cannot read this because there is a heart in the middle. So I don't know how to do it. I'm curious why you use those type of candles. These are not candles. These are bars. And you're curious why I use bars. I don't use bars. I use bars when I use bars. I use candles when I use candles. I use point and figure when I use point and figure. I use line on close when I use line on close. So the problem that I see with traders is that, they learn how to transport themselves, let's say, using a bike. And they think a bike is great. But now they only use a bike. And then they miss the train. And they miss cars. And they miss planes. And they miss all the other means of transportation that they could use because, well, they know how to use a bike. So we shouldn't just use candles. We should use and know how to learn we should learn how to interpret candles, which I teach in several of my videos on the channel. You will see that are with interpreting candles. But you should also know how to use bars and how to read them and interpret them. And you should also know how and when to use a point and figure chart or a line on close chart. Now, having said that about when to use and when not to use, I'm going to give you one last tip here, and then I'll let you be. Okay, let's go down to 4-hour chart, okay, where we are going to see one that failed. Okay, so is there a way that we can avoid these ones that fail? Because typically when they fail, it's because of reasons. So when you have a golden cross or a dead cross, that happened right after a huge, let's say a huge move on price that was abrupt, violent, so straight, so vertical that it almost forced the average to cross. Then you should ignore completely the crosses, the golden crosses, the dead crosses, and any other crosses. Because when that happens, typically the market is not going to continue forever. It's going to go back down. Okay, and it's going to revert to the means, as they usually say. But when they finish that, you will typically have one of those crosses, and you will ignore them because, they are not good at all. It's not worthy to use that type of entry where you see the market going up and then you finally see this crossing and then you say, yes, I'm so desperate to be in there because the market is going up. I want to be long. And that's the fear of missing out. And then when you get the justification to get in, then you get in and the market goes against you and you lose tremendous amount of money. So here it is, the way to avoid it. Anytime that the market moves or prices move abruptly, almost vertical, and forces the averages to cross, don't take that. That could have been let's call it an event, but not necessarily the beginning of a trend that is going to continue, that you're going to benefit from being participating in or anything like that. Okay, so now that was the last thing I wanted to share with you today. Let me see if I can answer any other question. Thanks for all the answers and teachings. I'm learning a lot. I'm glad that you're learning a lot, and I'm really happy to be teaching because I just love teaching. Anyways, I don't see any more questions coming in, so I'm going to say goodbye for now. Thank you so much for being with me today, and remember that we are going to continue doing 7 strategies that have stood the test of time. And we're going to have live webinars every Wednesday to discuss those strategies, as we just discussed this one. And also, just keep in mind that in between those 7 weeks, we're going to take a break because I'm going to be traveling. And so there will be a week where there is not going to be a Sunday video and a Wednesday live stream. Okay, so be aware of that. Thank you so much for being with us, and talk to you soon. Bye-bye.